All right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack. Very grateful that you would take some time to listen to us today. If this is your first time joining us, I am even more grateful that you would take time to try to figure out what this is all about. My name again is Chris McCormack. I'm a CPA, certified tax planner, founder of Better Books, where we are changing the game. We're really aiming to help business owners and real estate investors keep more money in their pocket, better utilize their numbers so that they can grow in a way that is full of confidence and not frustrating or chaotic. And we do that through a variety of services. I'm sure you're here to learn about tax planning and tax savings and how you can be paying the government less. That is our bread and butter, but a part of that also is the need for record keeping and bookkeeping and documentation. And so we offer a full range of tax planning and accounting services, partnering with some CFOs to really help you, the entrepreneur, the business owner, keep more of your money, better use your money, and grow your business so that you can accomplish all that you have set out to accomplish. Today, we're continuing our conversation on the 7 tax traps that people fall into. And this one is very important for all types of business owners. Now, we've titled this podcast, this channel, Know Your Numbers REI. We focus largely on the real estate investing community and business owners who are open to using real estate to offset their taxes. We have one client who is in the financial services space, and she will be investing in a property for her business, and that property will be yielding massive tax savings. So if you consider yourself a real estate investor, or you're a business owner looking to use real estate, or even just open to using real estate, and you might not know the power that real estate holds as it relates to taxes, then you have joined the right place. Now, if you get any sort of value out of this, or if you know anybody who might get value out of this, go ahead and share it with a friend. We know that entities are a big topic of conversation, whether you're in the tax space or outside the tax space. Everybody is talking about it. And that's why you need to be so much more confident that you're getting the right insight, the right information, because the wrong information will cost you thousands and thousands of dollars. It will leave you exposed to liability, and it will give you a headache upon headache. So you might get value out of this, but someone you know also might get value out of this, and I would encourage you to share it with them by the time that you're done. Also, if you have not subscribed to this show, whether on Spotify, Apple Podcasts, or YouTube, go ahead and do that so you will never miss an update. You'll never miss an episode. You will always be up to date on your tax needs and the important updates that come as a result of following us. But today we're actually going to be focusing on a wider topic, because while we have specific skills and knowledge and expertise in the real estate space, we know that that is just a piece of the pie that is your entire approach to taxes. And especially if you're in the business space, then it's not just the real estate you need to be concerned about. It is entity structuring. And so today, episode 4 of our 7-episode series related to the tax traps that cause people to overpay the US government, we're going to be focusing on entity structures. So yes, entity structuring is a topic of conversation that fills the airwaves of all sorts of social media, whether it's YouTube, Instagram, Facebook. I see accountants talking about it. I see non-accountants talking about it. I see real estate investors talk about it. I see coaches talk about it. And the thing is that you can go any which way and take a certain path that will lead a certain way, but that might not be where you want to end up. So again, it's important to have the right information when you make these decisions. I will say this: if you own everything in your own name, you are exposed financially, legally, and tax-wise. I know a lot of people get started and they think that they're going to get that LLC when the time is right and they start making more money. For now, they just want to get their business up and running, but this is not something you need to skip out on, because I tell you that there is always going to be something that's vying for your attention. The time is never going to feel right. This can go for bookkeeping just as much as it can go for entity structuring. But for the topic of today's conversation, we're going to focus specifically on entity structuring. I met an investor, I think 2022, so 3 years ago, probably right around this time. My wife and I were engaged. We were going out to meet this investor who was becoming a client out in Worcester, Massachusetts, and he had a 7-figure real estate business all under his personal name. He had 15 properties, was about to close on, I think it was 3 more. By the time we were done with the year with him, he had 21 properties, all under his name without any LLC or entity structure of any sort. God only knows what he was thinking, but I can tell you when I visited him in person, it wasn't the only chaotic thing he had going on in his life. He had paper mail all throughout his office. I saw IRS notices on poster board, on what do you call it, the little cork boards that people have in their offices, IRS notices, bank notices, paper mail everywhere. He was an older guy and it showed. He was old school to the T, but he still held everything in his name, and it led to extreme chaos. But more than that, it led to extreme liability exposure. It just goes to show that no matter what level you're at, you can get to a level that most people find inspiring and still have a lot to work on. I see this every day in our business. People are making millions and millions of dollars, but they don't have any bookkeeping. People are making millions and millions of dollars, and just like this guy, don't have any entity structure. People are making millions and millions of dollars and paying $500,000 in taxes as a result of the lack of planning. So trust me when I say this, just because somebody looks like they have it all figured out does not mean they do. And oftentimes there's things that you, wherever you are in your business, can get figured out that some people still do not at a level that you might find inspiring. Today, we're going to be talking about the cost, both known and unknown, related to this kind of approach, the approach that our investor friend who was a client took. And that's the approach of trying to figure it out at some later date, not getting set up the right way from the beginning. Operating without the right entity not only exposes you legally, but also robs you of tax efficiency. Sole proprietors, those who report their income on Schedule C, pay self-employment tax on everything, and they can't shift income to take advantage of structured distributions. What do I mean by that? I mean that when you first get your entity set up, when you first file your documents with the IRS and your Secretary of State, you are going to be either an LLC, or if you have a partner, you're going to be a partnership. Both of those entities, if you are generating ordinary income, meaning you sell a product or a service, you're going to be subject to self-employment tax in addition to federal income tax and state income taxes. So this is the person who goes and gets their stuff filed and then does no sort of entity structuring, no sort of tax planning as it relates to the way that their entity is set up. Why is self-employment tax such an issue? Because if you're getting self-employment tax on all of your profits, then that's 15.3%. Let's just take $100,000. Let's say you made $100,000 in profit, no entity structuring. 15.3% is $15,300. This is in addition to federal income tax and state income taxes. What is self-employment tax? It's the employer and employee share of payroll taxes. When you're self-employed, you're not taking a W-2, you're not taking payroll, and therefore you are subject to self-employment taxes. It's the government's way of saying, because you don't take payroll, we're still going to take payroll taxes out of you. We're just going to take it on your profit, as if you took the entire profit as a paycheck. And some people will take this and say, okay, then I'll just start paying myself a paycheck and I'll pay payroll taxes on my paycheck and then not worry about the profit. This too is exposing yourself to an unnecessary liability, because if you get yourself on payroll without setting yourself up in terms of an entity, the right entity structure according to your business, your goals, your desires, your investments, your operations, all of that plays into what the right entity structure is. And so if you don't do any of that and you just set yourself up on a payroll, okay, so let's say in the scenario I was giving, $100,000 of profit, you put yourself on payroll, you make $50,000 on payroll, the rest comes to you as a net profit. No entity structuring, that's a problem, because you'll pay payroll taxes on the salary that you set up, because that's your form of tax planning when you're left to your own devices. And then you still get the $50,000 in profit that is subject to self-employment taxes. And actually, you made yourself worse off because when you pay self-employment taxes, you get a deduction for a portion of the self-employment taxes paid. But when you do it on the payroll, you're actually lowering the amount of deduction that you're taking as a self-employed deduction. And so you're probably ending up in a higher tax result when you do it that way. And you guys might laugh and say, yeah, that's crazy. Nobody does that. But it's true. People do this on a regular basis. They think because I'm a self-employed individual, I don't want to do any form of entity planning. I don't know if that's right for me. I don't want to pay somebody to tell me it's right for me. So I'm just going to put myself on payroll and save on tax. And then you end up paying more tax as a result. So whether you're self-employed as a sole proprietor or self-employed with a partner, no entity structuring results in self-employment taxes out the wazoo. So what can you do? Well, you can plan. You can hire an advisor to come in and teach you the basics on the different entities and the benefits and drawbacks of each. And then you choose the right one for you. And then you ask, okay, what's the right one? Just tell me what the right one is for me. And I tell you, it depends on what business you're in. It depends on what you want to do with that business. It depends on who is owning that business. It depends on who the employees of that business are. There's a 1,001 factors that go into the equation of what is the right entity. But what we can do for you is to give you a better idea of what might be the right entity. Again, this is all under the topic of conversation of the tax traps that people fall into. So when people fall into this tax trap, they are completely avoiding the discussion of entity structuring. They're completely avoiding the need to plan around entity structuring, given all the factors that go into what the right entity is for you. So you as the listener are already a leg up on them because you are listening to this. And now that you have the information, I encourage you and I challenge you to not just let it sit in your mind, because so many people will come up to me and say, yeah, I know I need to be an SCorporation, but they've said that for the last 3 years and they haven't done anything about it. So knowledge is not power, it's applied knowledge that is power. By the end of this, I pray that you would apply this knowledge by hiring an advisor who can point you in the right direction. I would not ever encourage you to go and try to do this on your own. It'd be like trying to do surgery on your own in the medical field, right? Advisors are there to help you and to point you in the right direction because they have an experience that you do not have. You have the experience of your own business, and that's great. And each one has the wisdom that comes along with running their own business and in that industry. But as somebody who sees hundreds of cases each year, I know that no two examples are the same, but each example is going to give me more information that I can apply to the next case that comes across my desk. So at the end of this, you'll get all the information, but I want you more than that to be able to apply the information by reaching out to somebody that you trust and can see yourself working with so that you can run an entity structure plan so that you do not fall into this tax trap that so many people fall into and end up paying a large amount of taxes as a result. There's 4 entities. Let's start with sole proprietorship, partnership, SCorporation, and CCorporation. Now, partnerships can be limited or general partnerships, and you can have joint ventures. But for the sake of this conversation, let's just focus on those 4. Sole proprietorship, partnership, SCorporation, CCorporation. LLC is a limited liability company. You can be an LLC and be taxed as an SCorporation. You can be an LLC and be taxed as a CCorporation. You can be an LLC as a partnership. You can be an LLC as a sole proprietorship. So everybody seems to have this idea that you go out and get your LLC and everything's good and fine and you just set up your tax plan with an entity structure. That's not the case. Being an LLC does not guarantee any form of tax savings. Being an LLC is actually it's a good thing to do, but I think it gets blown out of proportion as to how far that step will take you. LLC is good for limited liability protection, right? LLC means limited liability company. You protect your assets that are in an LLC, but just going out and forming an LLC does nothing as it relates to taxes. You then have to either set up your financial systems to be tax efficient and tax friendly, or get an entity structure plan set up so you are at the best level possible given your business, your dreams, the pains you want to avoid, the employees you want to hire, the people you want to get to invest in your business. All of that factors into what entity is best. All right, so LLC. What is an LLC? A limited liability company. It protects you. Many people just get an LLC when it comes to owning real estate. Owning real estate, you don't necessarily have to do any sort of entity planning, but there's a caveat there, because if you own real estate and then you flip properties and you only have an LLC, the properties that you flip will be subject to self-employment taxes. Rental income is not subject to self-employment taxes, which is why just an LLC could very well work for a real estate investor who is buy and hold specifically. No flipping, no private lending, no wholesaling, right? All of that is ordinary income subject to self-employment tax. We've had a client who came to us, and he and his wife are spread across multiple industries in the real estate space. When I say multiple industries, I mean they do long-term rentals, they do short-term rentals, they do flips, they do build to sell, they do build to rent. So they're developing, they're investing, they're short-term investing, they're long-term investing, they're flipping. And you can imagine that it gets a little convoluted, especially when you don't have the expertise to point you in the right direction. And so that's what they were dealing with prior to hiring us, is that they had all these entities, they didn't know what was what, their books needed to get cleaned up. And so we had a lot of work on our hands. And by the time we were done with the cleanup work and the first year of tax work, we saw that the way that they were set up initially, especially as it relates to the build to sell and the flipping properties, was not friendly from a tax perspective. And so now we had to do some entity, even though they thought they had entity structuring done as far as taxes go, their entity structuring was actually done in a disadvantageous way, with the idea that they were going to pay more taxes as a result of holding those build to sell and flip properties in this entity that was taxed as a partnership. Why? Because properties, when you are specifically in the flipping space or the developing space, meaning developing to sell, you are taxed as what the IRS refers to as a dealer or developer. When you do that, your income, when you sell a property, is subject to ordinary income rules. Okay, so when you're a dealer or developer, you're subject to ordinary income rules. When you're an investor, you are subject to capital gain rules, capital investment rules. What's the difference there? Capital gains are taxed at capital gain rates, which cap out at 20%. Ordinary income is subject to federal ordinary income tax brackets, which taps out at 37%. And in the case of this client who had these properties that they were selling as flips and build to sells, developments to sell, they were also taxed as a partnership, which makes them subject to self-employment taxes. And so by the time that they were done with that year that they had come to us after the fact, they had a $50,000 tax bill because of the self-employment tax number. That is not fun. That is not something that you want to be dealing with, especially when your goal is to own real estate for tax benefits and pay no tax as a result of owning real estate, right? So what can be done? Well, you need to structure your entities properly. Build to sell and flips very well could be in an S-corporation, assuming you qualify. And some things that you need to qualify, you need to pay yourself a reasonable compensation. You can't have more than 100 shareholders. Your shareholders have to be individuals, or they can't be closely held corporations from my understanding. But the biggest thing is the reasonable compensation. That's the one that people try to avoid as much as the plague, if you will. And that's the one that the IRS will come after you, because what do most people think when they think of entity structuring? Because of everything that's available on the internet, they're like, oh, I heard that an S-corporation is the best thing you can do from a tax perspective, so I'm going to be an S-corporation. They don't hire the professionals to tell them what they need to do to be an S-corporation. And so they then go and make $500,000, take a few deductions, get profit of $400,000. That would be subject to self-employment taxes if they weren't an S-corporation. But that because they are an S-corporation, it all passes through to their personal income. They think they're good and clean. They never paid themselves a reasonable compensation, and now they owe not only the taxes on the $400,000, but if the IRS audits them, they'll also be subject to self-employment taxes, because they're going to say you're more of a sole proprietor than you are an S corporation because you didn't pay yourself a reasonable compensation. So your self-employment taxes on the $400,000, taxes and penalties and interest on all of that. You do not want to go down that avenue. And that's, again, why I encourage you and belabor the point of hiring a professional to point you in the right direction. Wow, we just covered LLC. So LLCs and partnerships, sole proprietorships and partnerships, if they're generating ordinary income, are going to be subject to self-employment taxes. S corporation, I kind of just went through it, but it is what's referred to as a pass-through entity. What does that mean? Is that the profits pass through to the business owner. So if you're an S corporation and you generate $400,000 of profit, you're the sole owner, you show $400,000 on your federal tax return and state tax return. And then you get taxed at the ordinary income bracket. So rather than having that $400,000 be subject to the 15.3% self-employment tax, you avoid the 15.3% and you only pay the federal income tax along with any of the other taxes that might come as a result of making $400,000. Net investment income tax, alternative minimum tax. These are all taxes that you want to have a plan for. But that's beside the point. We are focusing on entity. So S corporations are great for people who are generating ordinary income. They're taking deductions. They have less than 100 shareholders. They probably don't want to sell for a big multiple. And I say that because C corporations have the ability to exit up to $15 million under the new tax law and not pay taxes on the gains of anywhere from $0 to $15 million. So a lot of the startups that you know of are C corporations. Publicly traded companies have to be C corporations because they can't be subject, or they can't hold to that 100 shareholder requirement of S corporation. So what's the difference between an S corporation and a C corporation? S corporation is a pass-through entity. You get taxed at your personal income bracket. C corporations are subject to corporate tax, so they don't pass through to your personal income. You get paid dividends, which come to your corporate or your personal income tax, but the entity itself is taxed any profit on 21% corporate income tax. So some people are like, I would never want to pay corporate income tax and personal income tax, so why would I ever be a C corporation? But it does make sense for many entities. Well, one, fringe benefits are more friendly when you're a C corporation versus an S corporation because owners of S corporations are limited in their fringe benefits, and that's not always the case for C corporations. There's planning that you can do to bring the profit down on a C corporation and in a way get it taxed to your personal income levels. If you're at a 37% personal tax level and you're paying 21% at the corporate tax level, then there's that 16% arbitrage that allows you to maybe get more at the 21% rather than more at the 37%, right? That's a tax planning opportunity. So C corporations are not to be avoided like the plague. They are very opportune. They provide great opportunities for businesses that meet certain requirements. An exit, if you want to exit for a serious multiple, then you're going to want to be a C corporation. If you want to go and get funding, or your goal is to become publicly traded, C corporations are the way to go. So you can see that there's a lot of factors that come into entity structuring, which is why this is one of the 7 areas that people fall short as it relates to taxes. One is they think LLCs are a form of tax planning. They're not. If you just go with an LLC, you're going to be subject to self-employment tax. The other is going far too often to the S corporation, because the S corporation is not for everybody. It's not the best tax saver. No matter how many YouTube videos are made about it, sometimes a C corporation is the best thing for a business owner. So you need to be aware of the benefits and the drawbacks, and ultimately you need to plan around it and talk with somebody who has a grip on these opportunities, these benefits, and these drawbacks, the returns that come and the cost associated, so that you can make an informed decision, and a decision you feel confident about, and a decision that's going to reap a great benefit when it comes to your goals. Now, so then the question is, okay, if LLCs don't offer any form of tax benefit, then what's the point of being in an LLC? Why, Chris, what in that example did you say this guy was crazy to not have any LLC if it wasn't really affecting his taxes? And that I say that's a great question. And the answer would be you are exposing yourself to extreme liability. And also in the case of an audit, if you do not have an LLC, it provides them an opportunity to say you're not operating as a business and this is more of a hobby. And so these expenses that you're taking aren't really business expenses. We want to tax you on however much money you made. Like an LLC, one, provides liability protection. That's the biggest thing. It doesn't necessarily provide tax benefits, but it takes a step towards tax benefits in the fact that it makes you as the business owner feel a little more professional. And that's another thing, is that it is more professional. Rather than saying, hey, write that check out to Chris McCormack. No, write that check out to Better Books. It's our business. It holds you accountable. It gives you the opportunity to separate business and personal. So there are a lot of benefits. They're not necessarily tax benefits though. But I would say that the mindset that comes with owning an LLC, not only does it provide protection in the form that it would limit the liability to the assets held under the LLC, but also it makes you feel like a business owner, and it gets you thinking like a business owner, which honestly goes a long way, especially as it relates to taxes. Because when you're thinking like a business owner, no longer are you thinking about the expenses that you have to incur. It's like, how can I, as a business owner, take that expense and make it a business related expense? And that's going to be a topic of one of the final tax traps that we'll be discussing as a part of this 7-part series. But for now, understand that entity structuring is a huge piece of this puzzle. You want to make sure that you are planning around the structure of your entity. You want to avoid the idea that just signing the pages and filling them out and sending them to the IRS is a form of tax planning. No, everybody needs to make sure that their entity is set up for the success that they are aiming for. Otherwise, you're going to pay a boatload more in taxes than necessary, whether it's self-employment taxes or taxes on the sale of your business or any of the other forms of taxes that might come up. So stop leaving yourself exposed. If you have not done a form of tax planning around your entity structure, this is your encouragement and your challenge to take action on it today. If you're looking for a qualified advisor, somebody that you can trust, and you know that they'll be giving you all the information that you need to make a decision that you feel confident about, we'd love to see if our services are a good fit for you. You can go to our website, betterbooksaccounting.co, find some time on our calendar to meet. We'd love to get to know you. We'd love to hear what you're all about and see how we can align our services to best serve you and the goals that you have for yourself. Until next time, God bless you and keep moving forward.